Hi, I'm Jason Watson with WCG. I'm sitting with
Joseph Bassett.
Megan Oeltjenbruns.
And we are in segment 2 of our 4-segment podcast, I guess, on CRNAs. In our last segment, we talked about the overview of the industry and why converting from W-2 to 1099 makes a lot of sense. So if you haven't seen that, we would encourage you to go backwards and watch that one first. In this one, we're going to talk about entity stuff. It's a little on the boring side, honestly, but it's certainly a housekeeping thing that we have to do. So let's talk about the entity. What are you setting up, Joseph, for an entity?
It depends where they are. Okay. So most of the state boards we've been seeing, they need a PLLC, or
professional limited liability company,
or a professional corporation. So we don't really care which one it is, right? Because we have the goal of setting it up to be taxed as an S corporation.
Yep.
So whether they do the PLLC or the PC, we're going to go ahead and send off that S election and go from there.
Yeah. Does California still need you to be a PC for CRNAs?
I think so.
For physicians, for sure. Mm-hmm. Doctors and lawyers, yes. Or, lawyers and accountants, for sure. But yeah, sometimes the CRNA community gets a little bit, wedged in there somehow.
Wouldn't we prefer a PC in California, though?
We do.
Yeah. So, I mean, if they can qualify as PC, that's the way we want to go.
Correct. And we'll talk about that here in a little bit, about the SDI insurance stuff. So anyway, so setting up an entity. So just take a step backwards, I think a lot of folks who are watching or listening to this have heard about the S-Corp election, right? And it's a common thing. We're trying to eradicate this thinking client by client, but there's no such thing as a corporation. It's a tax effect. So you have to have an underlying entity, right? The primary ones are LLCs. The professional version of that, the PLC, a corporation, or the professional version of that, the PC. So yeah, there's no, you can't look at a secretary's website and say, oh, they're an S Corp. It just says LLC or Corp or whatever. So an S Corp is an election on an underlying entity. Setting up an entity is kind of simple in some states, complicated in others, right? New York, we still have to do a publication in a paper. Mm-hmm. Same with Arizona. I'm not sure why in New York, but Arizona is still the wild, wild west, so I think they're kind of old school a little bit on publications. Some are easy. Pennsylvania still needs a human, I think, to walk it in.
Oh, really?
I think we have to use a service there to walk in the paperwork. Don't totally quote me, but Amanda can certainly tell you about that. Colorado takes an hour. That's over lunch. It's really easy to do. It's really easy to do here in Colorado. Texas is pretty easy. Sunbiz in Florida. So anyway, setting up the entity is not a big deal. Setting up the correct entity might take some phone calls or information from your medical board if you're governed by a medical board in your state. So all right, so Megan, do you want to talk to our listeners about why? What's this magical thing called the S Corp?
Sure. So what it comes right down to is, you're making the switch. You used to be a W-2 employee. You worked for somebody else. Now you're self-employed, right? You work for yourself. And that's great, except for if you do nothing, you're going to get to the end of the year and the government's going to be like, oh, you work for yourself? Cool. We would like a bite of your entire income. We're going to call that self-employment tax. And basically it's payroll taxes that you're used to paying on your wage, but now you're going to pay on your entire gross income if you do nothing, right? The S election enables you to create a situation where you wear two hats in the business. You are both shareholder and employee. You pay yourself a reasonable salary. You pay your payroll taxes on that piece, just like everybody does.
What are payroll taxes? Just for
FICA, Medicare, and Social Security.
Medicare,
so you're paying
6.2%
for Social Security, both halves,
right,
and then 1.45 for Medicare. So it's 15% if you're paying both halves both on every dollar. So the S election, you create these two different buckets for you to pour your income into. You pay your payroll taxes on the W-2 piece. Great, you've done your part. That shareholder piece, the investment income, is excluded from self-employment tax on the tax return at the end of the year. So you've successfully shielded a chunk of that income from self-employment taxes.
Yeah.
Which can be significant savings.
Yeah, so go back to the two hats, right? So we have two hats. One is you're a member of the staff, mm-hmm, you're an employee, you're getting a W-2, you're getting a pay stub. On your W-2, you see Social Security taxes, Medicare taxes, all the stuff you would normally see on a W-2. And then when you're the investor, you only get taxed at the income tax level. You don't get a W-2 or anything crazy. If you make $100 selling Google stock, you don't pay Social Security or Medicare tax on that income. So it's very similar to that. So it's almost like investment income and then W-2 or wage income. And only the wage income is subjected to Social Security and Medicare taxes. And that's largely the only advantage of an S corporation. Maybe a lower audit rate risk, and maybe we can talk about that here in a second. But that is the big advantage, right? So some would say, well, make that salary as low as we humanly can, right? Maybe like $50, and of course we'll talk about reasonable compensation here in a little bit, but we can't do that. It's got to be reasonable and all that stuff. So let's just use that example of $100,000 that we've been kind of kicking around in segment 1 as well. How much money are you going to save by having an S Corp election on $100,000 of net income after your expenses?
$8,000 to $10,000.
Yeah. Mm-hmm. Yep, $8,000 to $10,000 because we're only paying that Medicare tax and Social Security tax on, let's say, $40,000 in salary or $50,000 or some number like that. So absolutely. So we have the savings of Social Security and Medicare tax. That is the big advantage of an S corporation. So now, this is a little bit tricky, right? When we start looking at converting somebody, they are a W-2 until, let's say, June 30th, July 1st, half of the year, they're going to convert to a contractor, and they ask, should I create an entity? Should I do the S Corp election? And what's your answer to that?
We usually get the entity going, because why not? Let's open up the entity, get you a little organized before we put our big boy S Corp pants on, So, but as far as pulling the trigger on the S election, we're usually going to defer it till 2023.
Yeah,
because
it depends. Yeah, go ahead.
Yeah, because I was going to say, if you have that W-2 where you're at 130, even 120 really, and you're going to make $100,000 as a 1099 for the rest of the year, you're so close to hitting the Social Security wage base on that W-2, which is $147,000, that you only have a little chunk that's going to be subject to the full 15.3% that Megan was talking about, and the remainder, 2.9% is going to be subject to it, maybe 3.8% for that surcharge tax. So that you're just going to be loss of those savings, because if you have W-2 wages close to $147,000, you really need $200,000 in 1099 income.
Totally, and even then it might still not work out.
Yeah.
So when I explain this to people, and sometimes you have to attack it in different ways, because they're like, I want an S Corp. I'm like, I'm telling you to wait till 2023 or next year. I want it right now. Okay. So I'll say you work for Hospital A through June 30th, and you made $100,000. They're going to take the full 7.65% in Social Security and Medicare tax out of your salary. They're also going to have to pay that as well. That's a total of 15.3, right? You go to Hospital B and you make $100,000. They too will take out the full $7,650 of your portion of Social Security and Medicare tax. That's cool. That's fine. When you put those two W-2s together on a 1040, you're going to get your excess Social Security refunded back to you. But Hospital A and Hospital B don't see those savings. So if Hospital A is some other hospital and Hospital B happens to be basically you operating an S corporation, paying yourself a salary, you're going to have what I consider forfeited taxes. You're going to take 6.2% times the overage above $147,000. So let's just do some quick math. If you made $100,000 at Hospital A and you paid yourself $100,000 as a salary in your next S Corp 1099 situation, you could easily have 6.2% times, let's use round numbers, 50 grand or 3 grand and just forfeited taxes gone unnecessarily. That's where we say, hey, why don't we just wait? And then you have to do an S Corp return. That's another $1,500.
You gotta get payroll running.
You gotta get payroll running. So all of a sudden you're $5,000 in the hole and you haven't done anything, you haven't saved anything. So that's why we say, hey, let's wait. You're $5,000 in the hole, maybe you still have to pay whatever it's going to be, $1,500 on the delta between your salary and your income and all that. But yeah, so we're kind of geeking out here a little bit on the actual percentages and the math. But the bottom line is, if you're at 120,000 and you're kind of halfway right now, it's August 3rd, then we're going to say defer.
Yeah, and it kind of lets you get a little bit more comfortable with being self-employed and having business expenses and a business checking account.
Kind of a baby step.
Yeah, doing estimated payments and all that stuff before we throw payroll and cash needs at you and opening up payroll accounts in different states. So when you have, 2-3 contracts to finish out this year, you're saving some money with not having to open up payroll accounts in those states.
Yeah, absolutely.
That's true. And then, and that's the other piece of it too is, let yourself get your feet wet a little bit. See if self-employment is for you, because some people it's not, and better to know that before you've,
let this big
complicated
fire.
your tax life. And then, but assuming things the same and it's January and everything looks good, that's the time to pull the trigger then. Get a full year.
I agree. So what we typically do is if you're on the border where it doesn't make a lot of sense, we are going to defer. That's cool. We'll say, hey, let's circle back probably beginning of November, maybe certainly before Thanksgiving, and kind of go, hey, how's next year going to look? Okay, it's going to look pretty good. Great. Let's go ahead and get the S-election sent off for 2023. Let's go ahead and get payroll accounts kind of queued up. Let's get everything going. December, we can still do it because we're not having to do anything by 12/31. It's just good to have those conversations sooner than later. So,
absolutely.
Anything you want to add to that, or?
No,
no, I agree. Anything else?
I think the biggest thing is, this is where we see the most, heartburn, I think, from people is just getting their hands around this idea of two hats, that you're wearing, that you're both the employee and the employer now. And so that's normal.
Yeah, it is. It's totally funny. It's funny you mention that because I'll say to the client, like, hey, I think $80,000 is a reasonable salary given what I know about your industry and what money you make and all these things. And they're like, okay. And you kind of see them freaking out a little bit because they're used to making 200, or whatever. And your next check's going to be this. You're like, dude, I can't live on that. You're like, oh no, you have another 120 grand that you can take out as a distribution anytime. And they're like, oh, okay, no problem. But though there is some getting your head around to wearing the two hats.
I like to tell people and this is very simplified, but think of payroll as how you pay your taxes. Think of draw as how you live your life. Yeah. Right. And that's what you got to get your head around.
Yep. No, for sure. And we do a lot of that. I mean, we should maybe talk about that in the next segment, but your salary is really a tax vehicle. We are going to use that thing to do your income tax withholding, so you're not having to worry about that stuff. So, all right, well, that wraps up segment 2, and in our next segment, we're going to talk about state issues, and those can get really messy really quick. And so anyway, my name is Jason Watson, and you're with WCG.